Hey everyone, good morning. Marty Missouri here, 3rd of August 2019. Going to spend just a few minutes with you. Want to update some things that I shared with you the other day. Point again to what I've been pointing to herein for months and let you get on with your weekend. So the chart in front of you is that daily S&P 500 chart. And you all who have been with me consistently on the videos know that ascending wedge patterns are bearish patterns. There are very few exceptions when the ultimate breakout from this particular pattern isn't lower. And you can see it here in some critical areas. This was back in September, October of last year, right up to the sell-off we had in May. We had a little one developing here, broke a little bit lower, but just for a few days. And we have this more, I would say critical looking one in here that we've been watching very closely. And for 3 days now, as you know, we've broken down here with some momentum and unfortunately for the bulls with some volume. And so the key things that I've been talking about here recently are beginning to unfold. Having said that, could we absolutely come back up here? We certainly could. The fact that we broke down below the wedge 3 days ago and then came back and tested it, this was really standard looking technical action. It almost always happens that we get a retest. And that retest was failed quite conclusively, and we closed down in here. Of course, ironically, right as we were testing that is when we got the president's tweet that as of September 1st, there's going to be a 10% tariff on all of the previously untariffed Chinese imports coming into the U.S. So, of course, that the timing couldn't have been better from a technical perspective if you were short in here, expecting for that test to fail. And that's essentially what happened. And then we came down here through this key level. On another chart yesterday, I showed these areas of resistance. And we came in here and for most of the day battled with that area right in there, 2940. Came down below it, and there was another level right in here that I'd drawn on that other video again yesterday. Came down right to this support level, hit it, and bounced off of that. And we actually had a pretty nice bullish move toward the end. Like I said in yesterday's video, we could absolutely get some news over the weekend that would have us come back and test these levels once again. So far, I'm not seeing much that would inspire that. There is rumbling that China is going to respond with some countermeasures. There's even talk of them canceling the face-to-face meetings in September. If that news comes soon, you are going to see, and I can say this with confidence, you are going to see a precipitous drop in stock prices. There's also hints, though, that there is quite the debate going on among the Chinese officials as to whether to retaliate but then continue with the scheduled talks. One mentioned that there's no reason why we can't have a trade war and have talks going on at the same time. But obviously the tweet was a surprise. China maintains that they are in the process of ramping up the purchase of U.S. farm products. They were inviting companies, Chinese companies, to apply for exemptions to the tariffs that China is levying on them on U.S. imports. There's no question that the president didn't get what he wanted out of last week's talks. But they did get, it looked like the minimum of what they were asking for. And there didn't appear to be any real confirmed follow-up on behalf of China's demand that Huawei have access to U.S. chips and so forth. So not good, and the market reacted accordingly. So now we have the technicals to deal with, and so we had a very bearish pattern in here anyway, in terms of just your price action. Now, as for the other things that I normally show, the other day I said this is beginning to look better. This is on balance volume. Well, this move right here is absolutely confirms that the bears at the moment are in control. And then our momentum oscillator, the MACD, remember I was showing you here, we had we had a short-term move into higher highs, and this was rolling over, and I presented that as a real negative signal. And sure enough, we've got this resolution lower. That makes perfect sense, and we still have this very clear negative divergence right in there, which is basically just giving you very, very strong odds that there'll be some degree of a sell-off off of these levels. And so we've got that now. The question, of course, and I'll spend a little time on that, is do we go further down, or do we bounce back? And then the same thing on the RSI. Got our bearish or negative divergence. Had the one I showed you here where we had a higher high, and we had this one rolling over. Very bearish on a short-term basis. This should have been no surprise to anybody who works with charts, or any technician could really see that one coming, and I have been illustrating that for you. So this was a really negative look. This basically assured that we were going to break down below that. Nothing's 100%, but these ones are pretty clear in terms of what they were signaling. And then something new that I introduced to you just this last week. This is the daily volume. That's the daily volume bars. We did this one first right here. And I explained here that we had the 10-day exponential moving average of the volume breaking down here below 500 million shares. And I pointed to other times when that had happened. You see when that happened here, we had that pretty good sell-off in May. You can see what had happened right up here, and we had the monster sell-off the fourth quarter of last year. You can see where it happened, a month or so before the correction that we had in early 2018. This was essentially the same look that we had below the big sell-off. I was just showing this to you again right here, and I was showing that we had relatively low volume in here. Well, now we've had the breakdown. Of course, this comes up, but folks, what you don't want to see is the high volume, and that was illustrated in the on-balance volume. But we have, low average volume while the market's going up, and then huge volume while the market's coming down. That's just not bullish in any way, shape, or form, but we were seeing that develop right in here, and that's what I showed you the other day. And again, this is not a good looking picture when you compare it to recent history and what this has been saying. But again, none of it means bear market. It just means prepare for a sell-off. And this is not, by the way, a big deal. I mean, if we resolve higher next week, which we very, very well could, this is just a blip. This is not even anything remotely like even May, which was, 6.75%, 7% decline. And it doesn't mean we need to resolve this way. None of this is carved in stone, but it does show us where probabilities lie, and the things that we should be concerned about. And before I go to one more chart, I'll finish up with this one. My concern, and this is expressed in the written blog, is that we get another drop like we got along here, which would still be a correction until we get below, on a closing basis, 20%, which would probably be right back down below that low here. We do this when we have an economy, in my view, with much weaker needs than it had back up in here. Back up in here, I was very sanguine. In fact, I was sanguine pretty much this whole time. As you can tell, those of you who've been reading the blog the last few weeks, that's not where I am today. My concern is that if we get, a precipitous drop and the consumer rolls over with it, and the trade wars don't go away very soon as a result, and if they don't go away and stay away, I just don't think we avoid a recession sooner than it would otherwise come, with a Fed that's really not prepared for it, and something messy. Whether or not we're talking 2008, that all remains to be seen. Of course, if we get there, I will offer up commentary along the way. But we're fine right here. In fact, let me just get rid of all this junk. You could also point right here, frankly, to a testing, virtual testing of this trend line right here. And right now that's holding up. So you could say there's some support there, maybe even double support when you add it in there. Of course, breaking down that would just mean one more confirmation that things are going to get worse before they get better. So if next week things don't get better, look for this 2890 or so as an area, because surely there's going to be some shorts running in here and some stop losses hit. That would be an area that was really strong support and resistance. So I think there's no chance that we don't get some pause in there. break down through these other levels. Depends on the news, though. If China retaliates and says we're canceling those meetings, and the president says, great, we're going to 25%, we're going to go down and we're going to break through these levels and we're going to have something messy to talk about. We're not there yet, so we don't want to put the cart before the horse. I'd say, maybe it's 50-50, if not better, that we bounce off of here and we have a good week next week. That's not going to change my overall bearish tone in here. Nothing will. As I've said all along, at these highs, they're not sustainable with protectionism and with trade wars looming. And we've got the one with China, but we're threatening Vietnam, which is where a lot of the production is leaving China and going to. And then the European Union, the European officials that deal with trade really believe that come the fall that the U.S. is going to impose tariffs on German automobiles. Let's hope that doesn't happen, and it may not. But I think the market needs to really do a number on the folks who are pushing for this, because I think the market will send a signal that they'll listen to. As long as we sit up here at these all-time highs, I think we're in great danger of seeing new, real ugly lows. Because this is not inspiring anybody to really do any fundamental changes in how they approach the global trade complex. Okay, lastly, remember last video with this chart, we did this right here, and I showed you that look, and this is just part of my weekly analysis. In fact, this indicator right here called the VIX curve is part of the financial market sub-index in our macro index that we created. So we had this big wide gap between the spot VIX and the 1 month future. We had it back in here right before this sell-off. We had it back in here right before this sell-off. We had a few in here that took a while to resolve lower, but they kind of led us to this. And then we had it right here just a few weeks before the correction in early 2018. So, and notice what happened since just a few days since I did that video. Sure enough, the VIX has shot higher. In fact, on an intraday basis, it got up in here. This is on a closing basis. And it was consistent, of course, with this sell-off in stocks. This look right here, and right here and right here suggests in all three or four cases that probably gets a little worse, at least before it gets much better. Doesn't have to happen because it's a very fluid environment, and it's going to be tweets around trade. Job number came out Friday. We had the Fed last week, so we don't have any other big catalysts. Of course, earnings are still out there. Good earnings aren't going to help much. Bad earnings could hurt. So right now, folks, it's just all about U.S. and its relationships with its trading partners going forward. That's going to be the biggest mover of markets. So I'll leave it there, folks. Thank you, of course, as always, for watching and listening. I'll be back very soon and very frequently. Take care. Bye-bye.